Joining us to discuss what is financing India's green economy are our esteemed speakers. Please join me in welcoming Mr. Shalabh Tandon, South Asia Regional Head of Operations and Climate Change, International Finance Corporation, and Sri Baldeo, Joint Secretary, ADB and Japan, Department of Economic Affairs, Ministry of Finance.
And joining them to moderate this discussion is Archana Chaudhary, Associate Director of Climate Trends. Let's give them a big round of applause, everyone.
So it's so good to see such an informed crowd here this morning, and the discussions since morning that we've been listening to have been extremely interesting and important. But I think we've come to the crux, the heart of what really will matter for India's transition. Because we're not just looking at an energy transition, a mobility transition. At the heart of it, it is a finance transition. Because all of it is going to need money. And the Iran war, as well as what has happened in the last couple of years, whether it has been the tariff tussles that we're seeing, the rising conflicts, and the changes in the way supply chains are being realigned, really does bring us back to India's policies of Atmanirbharta and how to become more self-sustained when it comes to climate finance. And so it's really a pleasure, gentlemen, to have both of you all here. I'd like to start actually first with Baldeo ji, with you, because... Okay, Purushartha. Okay, Mr. Purushartha. But if we can turn towards the policies that India is looking at when it comes to financing our transition, how has what is going on in the world and the transitions that we're seeing across trade, across our money, the taxonomy policies, how is India looking at financing of the transition as a whole across finance as well as our trade and money related policies, industrial policies? Can you give us a short overview?
I think, it's a question which is very, broad in nature. But I'll try to briefly answer that. So, financing to any sector, it's an ecosystem. It's not one short goal, but there are multiple initiatives being taken to finance the entire ecosystem. And it is not just one part of the system, but it's an end-to-end kind of, full supply chain financing kind of thing. So, green transition itself is very vast in nature. And let me explain at the beginning, because sometimes I was hearing the first talk. Sometimes we do not differentiate between energy and power. So energy is the entire use of energy in the country, whereas power, when we talk of power, we are mainly talking of electricity. So these are two different things. What is happening in greening power is different from what is happening in greening the entire energy requirement. So for any sector, the policy has to based on three different parameters. One, of course, it has to be supported by the government budgetary support. And when we say whatever is being financed, it is mainly by three sources. One, who is paying for it? Either it is to be paid by the taxpayer in terms of budgetary support, or it is to be paid by the next generation when loans are being taken for financing that particular sector or particular aspect, and the loans are paid by next generation to come, or it is paid by the user charges. Whoever uses those facilities sector, they are paying more for it. So it's a combined effort of touching all these 3 points. So if you see in last couple of years, in last decade you can take, there are a series of schemes and initiatives taken by Government of India to give more and more budgetary support to the renewable area, be it like green hydrogen mission or it's like the PM Suri Ghar Yojana, or it's like giving infra status to battery storage, or announcing viability gap fund, infra status to battery storage, and announcing VGF for battery storage as well, giving PLI for advanced battery manufacturing. So there are a lot of initiatives where the money is pushed by Government of India itself through budgetary support resources. The second part is to encourage private investment to come in. And that private investment come in by making an ecosystem or providing an ecosystem where the investments are de-risked to the extent possible. And this de-risking is happening by various efforts and support systems. For example, blended finance. It itself a big way of de-risking projects. And we have done successfully some large initiative of blended finance coupled with MDBs, especially the ADB, etc. And thirdly, to promote more and more private investment to come into it through PPP or through pure private initiative. I think 95% of our solar energy generation is through private investment. If you compare it with hydro, it would be upside down. 95% of the hydro is through government investment. So that gives you one idea of how things are happening on the financing front as far as renewable and energy transition is concerned.
So a mix of public-private, but also blended finance, which is a word that segues right into the way IFC thinks, because we've been hearing this word from IFC documents a lot. If you could, Mr. Tandon, take it from here and talk to us about what, since we're looking at an entire economy, how does blended finance then help to bring in more private sector investments, as well as which are the sectors that are more investable and which ones need to then step up a little bit more in India?
Okay, thank you. First of all, good morning, everyone. Glad to be here. As Baldeo mentioned, blended finance or VGF is one of the key ways in which some of the difficult sectors can be financed. But let me unpack this a little more and take some myth out of blended finance. Blended finance is not the solution for all the problems on climate finance that India is facing or any country is facing. Blended finance should be used very selectively and judiciously, because when we talk about the amounts of blended finance needed, the capital that is available for that is very limited. Either we tap some of the global donor funds, and given the geopolitics, our access to the donor funds is declining. So there's a very finite amount of blended finance that is available. Or if we look at towards the government, they have so many different uses of their budgetary support. Where should they deploy it for blended finance? Where should they deploy it from VGF? I'm sure the policymakers constantly have that debate. Where is the bang for the buck? When IFC looks at blended finance and when we define it, we normally define it as a temporary subsidy concept. It's not permanent subsidy forever. It's a temporary subsidy given in the early phase of evolution of a sector. For example, when solar started in 2003-04, I remember I financed a demonstrable solar project in Tamil Nadu using just concessional blended finance. Today it's not required. Market can finance it. So the road to sustainability so that the market can easily finance it should be very clear when you deploy blended finance. I think even the policymakers should make it very clear that I'm giving this blended finance at this stage of the journey of that project or sector. But after 5 years or 7 years, this will not be required and the sector will take off on its own. So that is, I think, the key, the road to sustainability. Very recently, we have given blended finance for a hydrogen project in India. That was IFC's first foray in hydrogen in India. It's the same way as we did in solar many years ago, and side by side we are working with the policymakers to create the entire ecosystem. When you look at the constraints for any sector, they are either demand side constraints, so not enough demand available, so government and public policymakers can come in and step in to help create the demand at scale. There could be some supply side constraints. The capital is sitting on the sidelines, but not coming in due to many risks. Currency risk is one of them, project level risk, macro risk, and all. Those are supply side. And then there is the whole ecosystem. Ecosystem when applied to a sector, whether it's offtake risk, whether it's contractual risk, whether it is credit risk of a project, that's the ecosystem. So when we apply blended finance, we have to make sure that all these three risks are eventually taken care in the journey. Thanks.
Thank you so much, and for explaining what it will take for private sector then to step in more, which is something that we have been talking about across sectors, not just in transition, but also otherwise, the need for private capital to step in more for the Indian economy to flourish. In terms of our transition financing, where do you think, Mr. Purushartha, if you could help us understand where are the gaps in the public finance architecture, what can be done to make that more, the fund flow more easy from the private sector?
I think gaps is a difficult term. I mean, one can understand that policies are always in the mode of evaluation. So the evolution. So they evolve with time. They evolve with need, and as per need, there is always a tweaking in the policy. So rather than saying gap, I think it's better to understand the challenges, So what are the challenges? Now the number one challenge is, of course, we have to arrange private investment at a scale. Energy is, or for that matter, power is one thing where the need of more and more power will come with time. I mean, one of the way of, looking at any economy to understand how much power it consumes. So more power would be required. To get that power, more investment would be required. And to get that investment, you have to bring in private investment, otherwise only government resources, or for that matter, blended finance will not take care of that. Now, how to give that comfort to the private investor? So comfort, of course, it can come at various levels. One is to come up with good concession agreements. It has to be, the investment has to be de-risked. There has to be proper, elements of termination payments, etc. These are things at the project level. Second, at the policy level. Now, if you ensure that there is a policy stability to encourage more and more renewable energy to come in, then all the various elements of supporting this initiative will start coming. Like, again, in the first session, it was asked when, for battery storage, we are more dependent on imports. Of course, because when more and more demand will start coming up, more and more domestic capacity will start getting developed. The issue is whether we do have a program or policy to support that. So, again, I am saying it has to be at various levels. There is no one-shot goal that only by hitting that goal you will achieve everything. For example, to ensure, you might be aware about this strategic petroleum reserve. This is one initiative. In the first phase, we started strategic petroleum reserve only with the government investment. But in the second phase, we took a conscious call that it has to be a PPP initiative. And for making that PPP initiative successful, government has announced providing a substantial VGF to it. So that is one part. I'm saying, I'm just giving you anecdotes of various policy parameters, how it is evolved with time. Then similarly, as I said, today the solar generation is so standardized that 95% of it is happening with the private investment. And more private investment is coming in. Now it's still government need to support it to ensure that the cost of capital comes down. More and more global funds are being channelized to that. The concessional green finance is channelized to that. And thirdly, which is much more important, is to ensure that the path which we have taken, like, the net zero path, the capacity to be created by certain time period. I mean, one participant said that India, in that net zero path, they have undercommitted and overachieved. If you say it like so, then it appears like a trickery, that we tricked to showcase our overachievement. It's not like that. achieving 50% of installed capacity, achieving 300 gigawatt of renewable is not an easy task. It has achieved with a lot of hard work, sweat, and persistent effort of the government. So, the third part, which is to ensure that there are policies which are amenable to attract investment into this sector. They are amenable to ensure a sustained demand, not only sustained, but it's an increasing demand as well. And there is a policy where commitments of the governments are being honored. I'll give you one example. In one state, I will not take name of that state, because the renewable cost is coming down, the generation cost is coming down. So some of the renewable agreements were a few years back, they were at a higher cost. So once the cost came down of the current bids, the government, state government became much more ambitious, and they tried to renegotiate it by not honoring the contract which they had signed a couple of years back. So ultimately, after a lot of fight, etc., ultimately concessionaire went to court and they won there. Now, this is a big challenge when I am saying that you have to create that comfort in the mind of concessionaire. You have to honor the contracts, you have to honor the policy, you have to honor whatever ecosystem you have created. Then only investment will come at scale.
And that is an important thing that you've raised in terms of honoring contracts and ensuring that projects themselves are investable, which is where I'd like you to come in and tell us more about what will then or can make projects in India more investable. If global finance needs to come into India's transition projects, what needs to change for that money to flow in? Because that is one of the largest or biggest, most important debates even internationally in terms of having money flow into global south countries like India. What needs to get better?
So, global investors, just like any investor, would look at the risk return for any project. If the risk return that you are getting by investing in India is better than or comparable to what other options they have across the globe, then the capital will flow in. That has been the premise of finance. That will not change. And that is the way to drive it. So and let's also distinguish between risk capital, equity and debt. When a bank or an institution within the country finances a project, it looks at the project risk and sees what is the risk return. An international global investor layers it and adds two additional risks to it. One is macro risk. Am I willing to take India risk? Do I have a better opportunity in another country? That's the country risk. I think given the scale of the markets and scale of the demand in the country, most global investors are happy to take the India risk and invest in India. The next is the currency risk, which has taken a big hit in the last 1.5 years. So the perception of global investors on currency has changed. So if they want to come into India as debt financiers, they are looking for hedging mechanisms or swap mechanisms so that they can take off the currency risk if they are coming as lenders. If they are coming in as equity investors, then the currency risk becomes even more important. So they are looking at their overall global portfolio book and seeing whether in US dollar terms or in a hard currency this makes sense and so on. I've seen the World Bank Group is working with the government and the regulators to see how we can play a role in managing this currency risk perception in a big way. Government has come out with big schemes and so on. When it comes to what will it take for global capital, it's already coming in depending on which of the sectors like renewable energy, standard, standalone, solar, wind, etc. is already attracting tons of global capital, pension funds, etc. Why is it attracting? Because all these three risks that I said, project level risk, macro risk, currency risk is being taken care of. Then there are a number of InvIT structures where the construction risk is over. You package it and then the risk is reduced. The projects are operational like we have seen it in the road sector. And then you attract global investors because the projects are already de-risked. They are functioning, they are operational, they are de-risked. You can attract global capital. So across the spectrum of climate projects, that's another model you can do for asset monetization and attracting global capital. Where the risks are very high, project risks are high, like whether in hydrogen or supply chain, where the government has come out with PLI scheme for ACC, battery, etc. That's where a lot of work needs to be done to attract global capital at scale at early stages. And that's what the role of the World Bank Group and IFC is. Our mandate is to attract that private capital by de-risking it at that stage.
Thank you. We have just about a minute left, and if I could trouble you, Mr. Purushartha, for a quick, to let us know quickly, because there are a couple of very important finance policies that everybody is waiting for. One is our taxonomy, and the other is the carbon markets. Can you give us some idea of what kind of timelines we're expecting and how that will help bring in money?
It's difficult to give any timeline, but I can only say because green taxonomy, I know it is being, done in DEA with the help of other concerned ministries, but that is in advanced stage. Capital market, yes, I think discussions are being going on, but there have been examples like we ourselves have gone for two in 2023 and 2025, two big tranches of green bonds, which we received good response. And in which again they are unlocking a lot of potential in green or renewable market. So there are instruments in the capital market which are doing well, but it need to be supported. Deepening bond market is again one big issue which we all are working in. One of the mandate was given to NAFED to come up with the credit enhancement initiative. They are already working with MDBs to come up in a big way in this sector. I think that will help a lot in deepening the bond market. But these are all evolving field, and very soon some of these things will come.
Thank you very much, gentlemen, for the overview, and thank you so much for being a good audience.
Thank you very much, Mr. Baldeo Purushartha, Mr. Shalabh Tandon, and Ms. Archana Chaudhary for this fascinating discussion.